Good afternoon, everyone. Today we'll be discussing the key implications and the analysis of the Union Budget, which was recently announced by the FM. So I will touch upon key major parameters. Firstly, if you see, there has been a keen focus on the containing the fiscal deficit. Without tinkering the capex plan by the government, which was announced in the interim budget as well. Apart from that, they have tried to make a balance between the social welfare spending, especially on the rural side, as well as developing the human capital in the country, which will generate employment for the youths. And there was some tinkering in the long-term, short-term capital gain taxes and the personal income tax slabs for the under the new regime. So these are the key areas which we'll be talking about and the impact on the sectors. So firstly, the fiscal deficit target for FY25 has been revised lower to 4.9% versus the expectation of or the estimate of 5.1% in the interim budget. So what does this mean for India? So firstly, the lower fiscal deficit is obviously good for the macroeconomics parameter, as it limits the government's borrowing plan, which is also largely flat compared to interim budget, and a marginal increase or not a marginal increase and marginal decline versus the last fiscal year numbers. So that limits the outgo of interest and interest expenses on the behalf of the government, and a lower fiscal deficit could result into upgrade of the country's rating. And further, the government is aiming to further reduce the fiscal deficit to around 4.5% in FY26. So these fiscal deficit numbers are very encouraging from the perspective of India's rating upgrade. Secondly, the overall capex outlay has remained intact at around 11.1 lakh crore, which is a growth of 17% on a YOY basis, despite a strong growth seen in the last fiscal year. So, though the number remains similar to what was announced in the interim budget, however, this is a significant growth and would continue to drive the growth in the industrial space of the country. Bifurcating this capex into different verticals, for defense, this growth is around 10-11% on a YOY basis. So coming on the capex part, the interim budget has estimated around 17% YOY increase in the capex, similar to what was announced in the interim budget, and this will increase the growth capex in the country and should be looked at positively, though it has been maintained at the level of interim budget. If we go by the industry-wise or the verticals, defense, there will be around 11% growth on a YOY basis. For roads and infra, it will be around 4% growth. For railways, it is around 3% growth. So larger part of this growth is coming from the capex assistance to the state governments, while this indicates that railways and road project will see some moderation in the capex and the growth numbers. But overall, this number is quite strong in terms of the overall economic growth of the country. On the other hand, what the budget has done, that they have increased the revenue growth revenue expenditure growth to 6% versus around 3-4% in the interim budget. So this supports the government's social welfare agenda, and that will support the rural economy as well the consumption theme in the country. And the net borrowing by the government has been kept stable at 11.6 lakh crore, and it is lower than FY24 numbers, and that is positive in terms of lower interest outgo by the government. However, on the negative side, there has been increase in the short-term capital gain to around 20% from around 15% earlier. And the long-term capital gain has been increased to 12.5% versus around 10% earlier. We have seen some sentimental negative impact of the same on the budget day, where the market nosedived more than 1,200 points on the BSE or Sensex. So that impact we think that is largely over for the markets. and the broader picture should be looked upon from the revival in the consumption, capex story, and development of the human capital. So human capital also the government have put a special focus where they have clearly stated that they will be putting up outlay of almost 2 lakh crore over next 5 years. This will be used to develop human capital in the form of assistance in terms of the first month salary, internship programs, benefit in terms of the PF contribution. So that is clear focus of the job creation by the government for almost around 4.1 crore youths in the country. So that is also a positive move by the government. So in a nutshell, apart from the talking of the short-term, long-term capital gain tax, the budget is quite prudent in terms of balancing between the growth as well as populist measures of the government. Special focus was also given to two states which are Bihar and Andhra Pradesh. So a lot of infra development has been lagging at these states, and the government will be pumping up significant amount of money over next couple of years in these two states to develop the road projects, other infrastructure in terms of airport, sports infrastructure, medical colleges. So almost around 26,000 crore is allocated for road projects, and all in all around 59,000 crore to the state of Bihar. Andhra Pradesh was also given a special financial support of 15,000 for this fiscal year, and additional amount will also be allocated to Andhra Pradesh in the coming years for the development of the state. In terms of the personal tax, there has been changes in the tax slabs, wherein this will benefit the individual taxpayers, and there was tweaking of the standard deduction, wherein like the limit was increased to 75,000 from 50,000 earlier. So this will result into incremental tax savings of 17,500 for individual taxpayers under the new tax regime. So if I sum up in one line, the budget presented by the government was quite prudent, except for capital gain taxes, which is a near-term negative for the broader equity market. Overall, the announcement were largely in line with the interim budget, and there was a balance struck between the fiscal discipline, need to revive consumption in the rural economy, and continuation of the domestic capex along with job creation. So I think that it is quite prudent budget. In terms of the sectors which may benefit and the companies which may benefit, the key beneficiaries first is your consumption companies like ITC. They will benefit from higher income in the hands of the people, and also the support for the rural recovery will also help consumer focused companies. There was a rationalization of taxes on the imports of gold, which will benefit companies like Titan. NTPC and BAIL will benefit because there was a lot of emphasis on renewable energy and recycling thing, which will benefit the recyclers like Gravita India. So these companies will continue to benefit, given the government focus on the rural housing, and also as well as the urban housing. The housing finance companies like PNB Housing, Awas Finance would be the key beneficiaries. Consumption theme, Zomato will also benefit from the consumption theme. Tejas Network would benefit from high duties on the telecom equipment. They're working a lot on 5G equipments that will be so it will be key beneficiary of higher imports on the telecom equipment. On the negative side, electronic manufacturing companies will be impacted, like Dixon, as there was lowering of the import duties on mobile phones. It is a key player where it provides supportive equipment for the electronic equipment for the mobile thing. So that will impact the overall growth for Dixon, and thus negative for Dixon. Tweaking of the gold import rates would impact the gold finance companies like Muthoot Finance, Manappuram Finance, and the increase in the capital gain tax and STT would be negative for exchanges as well as broking companies like Motilal Oswal, Angel One, and BSE. So these are the key budget beneficiaries and budget negatives in terms of the sectors and the companies. This is a brief uh, bifurcation of what was the tax regime earlier for the people opting for new tax regime and versus the revised tax slabs. So this will give around 17,500 crore of 17,500 rupees of annual benefit to the taxpayers without cess, and with the cess it will give around 18,200 rupees benefit on the annual basis. So this will boost the consumption thing in the country. Now, if you see the numbers in terms of the fiscal deficit, last year the fiscal deficit was almost 5.8%. Now the target is around 4.9%. So there is a significant improvement on the expectation on the fiscal deficit. Now there's one important part too, is that around 1.3 lakh crore from the RBI dividend will play a very important role to reduce this, and this will not be a recurring thing going forward. So for FY26, though the target is encouraging at 4.5%, it has to be watched out how it will be achieved. I think that it will be more of more tinkering with the direct and indirect taxes, which would support lowering of fiscal deficit. Second chart is like capital expenditure. As I mentioned that there will be around 17% growth. If you see since FY21, the capex has been on a significant growth from just 4.1 lakh crore. The estimate for FY25 has increased to around 11.1 lakh crore. So there has been a significant jump in the capex expenditure by the government, and that is positive for the industrial in the long term, though there may be some concerns because of the non-revision of the estimate in key sectors of versus the interim budget. So that is a short-term negative. So there will be some profit booking in defense railways. In terms of the sectoral impact, starting with the FMCG sector, there has been quite a few measures taken by the government. First, I mentioned that lower taxation, which will add to the disposable income. Focus on the rural development, where they have allocated almost 2.66 lakh crore for the various schemes. Development of the youth, where they have 2 lakh crore of outlay plan that will give the income to the youths for spending. So this is positive for the entire FMCG space, like ITC, Dabur, Gojal Consumer, and Tata Consumer. There will be financial support for shrimp financing, and nucleus breeding centers will be set up and there will be also investment in the processing and export. This will help companies like Avanti Feeds and Apex Frozen Foods. So this is positive for these companies. On the consumer side, I mentioned that Titan and Kalyan Jewellers will benefit as there will be reduction in the import duty on gold to 6% from earlier 10%. Apart from that, services industry, they will benefit in terms of higher team leads, NIT learning system, as well as tourism allocation has been also strong. That will benefit the tourism companies. Internet companies will also be positively benefiting from higher disposable income, like Zomato, Jubilant Food, Devyani International. BFSI, largely it is positive for housing finance companies because of the focus on the rural as well as urban housing projects for the middle class and lower middle class people. So that will be positively benefiting housing finance companies. The fiscal deficit target of 4.9% would be positive for banking system, especially SBI, where it will help overall banking system in the form of lower interest cost and lower interest rate. That it helps in the overall macroeconomic stability for the country as well as banks. For insurance sector, there has been no change in the tax rate for life insurance. So positive for the space companies like LIC would benefit from this. Uh, Real estate, there has been a neutral to positive instance because uh, the uh, the new housing projects will also be positive for the real estate developers, as well as the long-term capital gain tax has been rationalized to 12.5%, but the indexation has been removed. So post this change, like the people who are reinvesting in the property, that will be given gaining more momentum, and that will increase the flows to the real estate segment, and that is positive for players like DLF, Prestige, and Godrej Property, the big players. uh, a lot of focus on housing projects and the rural development projects would help the cement and building material space. Ambuja, Ultratech, Prince Pipe, all these are beneficiaries of these things. Power utilities will be a key focus area because there has been a lot of shift towards clean energy, and rooftop solar projects are also given emphasis. Uh, there will be also focus on the pumped storage projects wherein renewable energy integration will be done. Uh, there was a JV announced between NTPC and BAIL for a 800 megawatt supercritical thermal power plant with a new technology development. So there has been a higher allocation for renewable energy as well by the government. So smart metering will also gain momentum. So this is positive for the power space. Tata Power, NTPC, BAIL, Borosil Renewable will also benefit. So these will be the clear beneficiaries. Uh, uh, for fertilizer and agrochemical, largely the fertilizer subsidy has been maintained at 1.64 lakh crore, and that is neutral for fertilizer and agrochemical players. Um, Consumer durables, there has been change in the custom duties on mobile phones, mobile chargers. So that is negative for Dixon. And for telecom players, it will benefit from lower custom duty on telecom products. Keynes and Simra will benefit from these measures, and even the Tejas networks. Yeah, so this is all from my side. We can open the forum for Q&A now.
So, question one, what is the post-budget investment strategy?
See, budget has focused on both capex and the revival in the consumption theme and the rural economy. With the capex target remaining intact, though they have not been increased, the focus should be more on consumption players like ITC, and the players like which are more rural focused FMCG companies that should benefit from the revival in the rural consumption. IT sector can also do well going forward because of the reasonable valuation and likelihood of cut in the US Fed interest rate, and the management commentaries has been strong there. We would advise investor to be booking profit from the industrial space, especially the railways as well as defense space, because of the high valuation, and as the capex has largely been maintained. There has been no increase in the overall capex plan by the government. So be overweight on consumption theme, be overweight on IT space. That should be the key focus area for the investor, and book profit on the industrial part.
On to question two, what is the impact of the budget on the capex industry?
So as I mentioned that government has largely maintained the capex plan as was mentioned in the interim budget at 11.1 lakh crore. So the capex they have made kept it intact. So I would advise that the capex related growth will remain intact, but no incremental announcement is a bit negative for the industrial and capex related sectors.
Question three, what is the future market outlook post the budget and what is the Nifty target for short term?
See, markets are expected to remain range bound in the near term, as the the two major events domestically are now over. First, the general elections. Again, there was a appointment on that side on the budget day, on the election day, and now the budget is also budget excitement is also over. And though budget is prudent, but we have seen the volatile moves post the budget. So market would move in a narrow range until there is a cut in the US Fed rate. So that will be the key trigger to be watched out in the second half. Until then, the markets would remain range bound in our view.
To the next question. I have long-term capital gains on 1st May 2024 before the budget announcement. So how much capital gains tax do I have to pay on those gains? 12.5% or 10%?
It will be 10% because the higher tax rates are prospective and not retrospective. So it will be most probably on 10%.
On to the next question. Which sector looks promising for the next 1 year?
IT, consumer, and agri and specialty chem. These are the sectors which have not performed that much in last couple of years. And with the money shifting or the capital sector allocation moving to from industrial to more of consumer and IT theme, we will see these sectors to be more favored in next 1 year. IT, consumer, agri, and especially chemical.
What is the impact of the budget on the fertilizer sector?
So as the fertilizer subsidy has been maintained, there has been no downward revision or upward revision. So that is largely neutral for fertilizer companies. Even the raw material prices have been lower for fertilizer companies. So that reflects the YOY decline in the fertilizer subsidy provisioning. So that, I think that that is neutral. Budget is neutral for fertilizer companies like Coromandel, etc.
On to the next question. What is the implication of removing indexation for real estate, land, and houses?
So apart from removing the indexation, the government has also lowered the long-term capital gain tax to around 12.5%. So a person who is holding a real estate for a longer period of time, 20-25 years, there is no material impact on the tax outgo. But the people who are investors for a shorter period of time, they will see higher tax outgo due to removal of indexation. That is the category which will be impacted. But having said that, the people who are investing the money in buying a new property, there will be no implication for them.
Thank you, Abhijeet.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.